Good afternoon, I'm Brigid Taylor and this is Currency Wars. Let's have a look at what happened on the wires this week. All eyes were on the FOMC minutes from the March meeting, where the policymakers were split over whether or not to raise interest rates in June. While the stronger dollar was noted to pose risks to the export growth in the US going forward, the lower oil price posed risks to inflation meeting the 2% target. But bear in mind that these FOMC minute debates took place before the payroll data, and the weaker US data prompted the Fed officials to be less hawkish on the June hikes. The market's now priced for hikes later in the year, in fact after September, and most are pricing for a December 2015 hike. Meanwhile, in Europe, we continue to see signs of recovery, and data released yesterday showed that there was stronger than expected German factory orders, as well as the European zone retail sales growth in February. The German economy remains robust, and this is supported by the weaker euro, the historically low interest rates, and a strong domestic fundamental. Meanwhile, in South Africa, despite the possibility of a period of dollar vulnerability, which may spark a rand relief rally, news on the local front is anything but rand supportive. And this week we saw the rand trade in a very narrow range of between 11.78 and 11.90. Right, now that we know what the lay of the land looks like, I'd like to welcome my guests, Jan Sluis-Cremer from RMB and Andre Cilliers from Treasury One. Welcome, guys. So let's talk about where we are now that we've gone post those FOMC minutes. I mean, we have had a quiet week just with the Easter weekend, but obviously non-farm payrolls coming out on Friday was a little bit of a humdinger just because it was a negative number. So from your perspective, what do you think in terms of a lot of the commentary that's come out of the Federal Reserve? I mean, we had the New York senator talking about their views with regards to the interest rate hikes coming out of the US. What is your view in terms of that trajectory?
You know, Bridge, I think, non-farms came out on Friday. It was a public holiday. It was only the US working. So there was also perhaps a little bit of over-exaggeration through the markets. I mean, that rand literally dropped from 12 rand to the dollar where we closed on Thursday night to sort of the 11.75 level in literally 20 minutes. I mean, 20 big figures on the back of probably a handful of dollars if that went through the market. So market was probably overdone. As far as the Fed is concerned, you know, I think people, and we've said it before on numerous other occasions, people had got themselves ahead of expecting a raise hike as soon as June. You know, we'd spoken previously about, you know, inflation is not growing, wages, bills aren't growing. You know, whilst more people are being employed, it's all very good, but the rest of the economy wasn't taking, and prior to the February numbers, we'd seen a lot of data that was coming through that wasn't that great in the US. And, you know, it kept on getting blamed on the weather and getting blamed on this and getting blamed on various other issues. But you can't carry on blaming. And I think Friday's non-farm payrolls kind of put a line in the sand there going, hold on a sec. You know, strong dollar is hurting, low oil prices is hurting, inflation's not going anywhere at the moment. Job market's probably not as great as everybody thought it was. So just hold back on those interest rate hikes. And June probably was, you know, being a bit presumptuous.
It probably was, and I think that, you know, as you mentioned, I think the key factors were, I mean, Bernanke said it from the beginning when they pulled back the quantitative easing, looking at that 5.55% ideally on on your unemployment, and then looking for that 2% in terms of the upside trajectory on inflation. They really weren't sure at that time what the impact would be with all the quantitative easing, if in fact we would see this inflation coming through. But as you mentioned, I mean, with the oil price that much lower, you're importing it so much cheaper because your dollar's so cheap. What is, you know, the outcome in terms of, so we've got lower unemployment in the US. They're sitting at about that 5.5 level, which is, it's good, but the inflation number is really what's key right now, and especially if you're not seeing that wage increase growth. So from your perspective, Andre, what do you think is going to be the projectile that will push that inflation number where we will start to see some pressure come on the Fed again to talk about the interest rate hike trajectory?
They will not change the interest rates before they've seen inflation at 2% and above, with a very clear direction in the upward move. And Yellen, and we've spoken about this 2 weeks ago, Yellen had clearly pointed out during the Fed minutes or a press conference after the meeting that stop looking at one number. And too much emphasis is placed on one number, and one number does not determine an economy. But that having been said, we're seeing better numbers out of Europe.
Yes.
We've seen the weighing of a weak euro and a strong dollar on the American economy and the favourable side for the European economy.
And particularly Germany. I mean, their trade numbers are particularly good. I mean, we've seen those increasing. Why? Because they can export at such beneficial rates,
But
right?
another one, we come into the summer season of Europe now. So they're going to get a bit of a boost. Their retail figures are looking better, but they're going to get a boost on their retail side from tourism that comes in over the period. Apart from that, a boost from their own people actually staying in the country and not being outside their countries on holiday and vacation in their winter periods. Lower oil price, lower oil usage in the summer periods. So all favourable for the European economy. So watch out for, and we said it once again 2 weeks ago, a much slower decline of the euro than we have seen before.
Well, it has been. I mean, and it didn't break through that par level. Well, I mean, not significantly. We're trading in that sort of 1 to 110 level. We haven't really moved between 105, 108. It's kind of stayed around those levels. So I agree with you. However, if we bring it back home and we look at the South African economy, so we've got this credit or our interest rate spread. So if we look at the US economy particularly, the US 10-year now sitting at 188, where it was sitting over 2%. So that spread between the rand, you know, the interest rates in South Africa and the spread in the US is narrowing again. Do you think that that's positive for the rand? Do you think that we continue to see inflows into South Africa as a result of the carry trade?
Look, I still think so. And I kind of, alluded to earlier on today in a conversation that, you've got, the rand should actually be a lot stronger than it is if you compare ourselves to our fellow emerging market peers. But I think internally we've got our own problems. We've got Eskom threatening strikes and going on more strikes. They're already struggling to keep the plugs on. There's been noises about land grabs and various other issues. And that keeps on putting a negative dampener on the rand and on our local economy. Foreigners are still buying bonds, and it's still, a bigger picture. It's still a good carry to have.
And it looks like it's going to persist for the remainder of the year, because I'm going to ask you, just in terms of your view, do you think that we're going to see interest rates now towards the end of this year? Where are you pricing as RMB?
Certainly on dollar interest rates, I think certainly now you're going to start looking at September, probably even December now.
Okay.
And especially in the light of the data that we've had in the last couple of weeks and after Friday's numbers.
So if we don't see interest rate hikes out of the US, we don't see, the European zone is going to continue to support that economy and keep interest rates low. That should be rand supportive. And what is your view in terms of continue to see this foreign inflow that supports the rand? And also talk to us about some of the underlying risks in the local economy. I mean, Anglos, we're talking about a coal strike. So those kind of uncertainties are coming back on the table.
Well, we're going into strike season, and we've seen the rejection of the government sector, the civil servants rejecting the offer from government. So we can expect a strike there. Workers at Anglo American's one mine, one of their coal mines, has gone on to an illegal strike, but it's a strike nonetheless, and that's going to circle out. The turmoil that we have in Cuscato is definitely not rand supportive, and I can see and foresee that that's going to create further strikes and further upheaval in the labour market. So a lot of signs in the market that's not rand supportive. Yes, we'll continue seeing inflow of bonds, but we'd better address some local issues very, very quickly, otherwise we're heading for big trouble.
Well, I think that that's the key, and I think that, we've said it before, the rand is being forgiven because of the offshore factors that are driving it, but unfortunately our underlying factors remain. So we're going to have a look at where our guests are looking for the levels to watch out for. So stick with us. Right, so we're going to pull out the big guns. Time to put it on the block. Give us your views with regards to where the rand's trading at the present. How much volatility you still expect in the rand, or do you think that that's sort of subsided for now? And then obviously the levels that we'll be watching. Andre, I'm going to start with you.
Okay, dollar rand, I think we're still going to see the volatility. I think we are trading in ranges, or foresee ranges, between 11.75, so we're very much close to the bottom. On the upper side, 12.05.
Okay.
Euro, I'm getting less pessimistic, so there I see 12.75, 11.75. I'm getting my own big figures wrong here. 12.75, but most probably trading back to the 13 levels, possibly breaching that 13 pound, 17.55, 17.85.
Okay, so bottomish on the rand, and you, Jan?
Look, I mean, I think for the rand at the moment, I mean, a vast majority of the country is still on Easter holidays. So liquidity in the market this week it's almost non-existent. Trading very tight ranges, bit of consolidation, certainly a lot of local demand on the downside. I agree 100% with Andre. Anywhere sort of the 75, 78 levels, look to buy your dollars again. We just got to try and get a daily close above now the sort of the 785, 786 levels, and definitely a move then back up to sort of 1198 and even possibly 1205 again. Euro rand, a little bit different there. I kind of think that we've broken some sort of key technical levels, and I'd look for a period of consolidation, certainly 1270, 75 on the downside, but probably a little bit of a move back up to the sort of 1280, 1285, but I certainly don't see it going much beyond there unless we have a complete meltdown in dollar rand again.
Yeah.
And which we're kind of not really expecting in the sort of the week or the next 2 weeks. And sterling rand is very much range bound. I mean, I agree with Andre, 755, 785. We're below the 100 and 200 day moving averages. So top side sterling rand to get back above 18 is again going to have to take a real big event for it to move through there. Otherwise, 1785 topish for now.
Okay, thank you so much. So just in conclusion, we're looking for rand to base around that 1175 level, and the rand's really the thing to watch right now if we're looking for further weakness on the crosses, because the crosses look to be pretty range bound as we see the pound as well as the euro pretty consolidated around those current levels, potentially seeing further strength in the euro, which might see that 13 level against the rand be breached once again. So watch your dollar rand, take advantage if you're an importer. The bottoms are in, and they certainly are being well supported. So 1175 on the rand at the bottom, and then on your euro rand around 1275, the pound about around 1755. Otherwise, thank you so much once again to both of my guests, and have a super week. And if you'd like to contact us or give us any of your suggestions, you're welcome to do so at CNBC Africa #CurrencyWars410, or you can contact myself at Brigid R. Taylor for your personal response to the FX markets. Until next week, good luck in the trenches.